Ladies and gentlemen, we are starting with the next session. So for that, I would like to request Mr. Nirav Shah, Group Head, Corporate Banking and PSU, Mr. Jimmy Tata, Chief Credit Officer, to present the corporate cluster.
Yep. Okay, good morning everyone. So what I'm going to cover very quickly for you all is the corporate landscape. What was HDFC Bank, corporate bank doing during this particular time in terms of the corporate ecosystem and what more to expect out of the corporate bank as we move into the future years. So first thing is, and let me start from the basic, what was happening in corporate India. One, as all of you all know, a lot of balance sheets got deleveraged. So as we came out of the first wave of COVID, we saw EBITDA margins moving up. So while values were going up, the capacity utilizations were coming down. There was ample liquidity in the system, interest rates were low, and corporates decided to deleverage their balance sheet. And there were certain sectors and companies across sectors where we witnessed deleverage of balance sheet. During this particular period, we saw unprecedented levels of foreclosure. And while there were deleveraging on one side, there were a set of corporates who believed that they should shore up liquidity. And some of them ended up taking or drawing on their working capital lines just to keep liquidity. What were the opportunities for us? On one side, when we saw interest rates coming down, we realized that there is a great opportunity for us to refinance some of the existing debt sitting across corporate balance sheets. So that was one avenue. Second was, there were a set of companies who wanted to draw working capital lines and keep themselves liquid. Nobody knew what is going to happen through the pandemic. So we participated on the working capital side. Third thing that we did was in terms of ensuring that we increase our disbursement run rate. So between working capital utilizations, refinance, and participating in capex, which was limited to a few sectors, we ensured that between maturities, between foreclosures, but our disbursement kept pace and we offered a balance sheet growth. The other factor that happened was in terms of the digital adoption. We realized companies started working from home and pandemic acted like a catalyst. At this particular point in time, and we would cover corporate volumes, 94% of transactions were processed untouched by human hand on the transaction banking, collections and payments. We saw adoption of our Trade on Net platform, and 87% of transactions on international trade were again processed through a straight-through processing mode. And through this digital adoption, we saw an increased traction in our customer engagement on transaction banking. Over the last few months, there have been two things. One is the government expenditure. So that part of the GDP has picked up. There has been monetization of certain assets. We have seen early draws on the PLI scheme. We are seeing in terms of certain green shoots in terms of capex across some of the other sectors. We have seen monetization and InvIT structures coming in where the credit risk on project side is out. There are stable cash flows and better debt equity mix for the bank to participate. So we saw some capex coming back through all these schemes. The last thing is post the tension between Ukraine and Russia, we saw disruptions on the supply chain side. And this is something that corporate India is worried at this particular point in time. What they wanted to stitch up their supply chain better. And in Q3 of FY22, we launched our new supply chain platform. This has helped us to actually provide assistance to the entire supply chain of our clients. So whatever we did, what did it translate into? So if you look at credit growth, large corporate credit growth, March 22 year on year was 0.9%. And HDFC Bank ended up having a credit growth of 15.7%. So we were 16, 17 times, we grew faster than the market. If we look at it over the last 2 years of pandemic, we have had a CAGR of 22%. The good part about our credit book at this particular point in time, it is very well diversified across tenors. We are also very well represented through various industries. Plus, we have a large part of our loan book which is linked to a benchmark, and it is floating rate. So in terms of our ability to pass on rate hike is that much superior. The growth in the book was both in the public sector space as well as on the private large corporates. Today, 62% of the book is large domestic companies, 38% is public sector. If we look at it in terms of growth, public sector last year grew 13%, private sector grew 17%. In terms of the quality of the book, continues to remain pristine. Our weighted average internal rating for the PSU book is 2.84, which means when I translate it into an external rating, all of you all would be able to relate. It would be a AAA portfolio. Our internal rating on large Indian companies is 3.83, which means it's a rating that would be somewhere between a AA to a AA plus is the effective rating of our book. In fact, when we look at it in terms of the portfolio, today 93.5% of our book is rated A, AA and AAA. If I was to just look at AAs and AAAs, it would be somewhere around 87%, and actually 49% of the book today is rated AAA. In terms of, we have spread across industries. If we look at it in terms of where did the growth come from, some of the industries which witnessed credit growth came from agri, food, beverages, in terms of infrastructure spends, in terms of telecom and services. Some of the sectors where the deleverage story was more pronounced was in metals, minings, minerals, chemicals, fertilizers, pharma. But our portfolio is spread well across industries. So in terms of what is it that corporate bank does? We are today present across the entire corporate ecosystem, and we touch various parts of a corporate. So whether it is, we are a financial supermarket, whether it is in terms of servicing the corporate needs when it comes to funding, both through working capital and term, in terms of the cross-border transactions and facilitating through both imports and exports, in terms of managing the domestic supply chain, whether it is in terms of funding of vendors or customers, or whether it is in terms of handling of transaction volumes, both collections and payments. In terms of how do we leverage our relationship with the customer and add value to corporate employees in terms of salary engagements, in terms of how do we participate and aid government with tax collection through all kinds of statutory dues that we collect, and effectively at the end of it, how do we distribute the earned profits by way of dividend to the shareholders. So we are present across entire product suite when it comes to corporate clients. So just to touch upon a few aspects, and there were a few questions in terms of the corporate bank profit margins in terms of the NIM. So we actually represent and bring together one HDFC bank to the client. If we look at it, today we have salary engagement on the corporate side with more than 2,000 companies. There are 44 lakh employees in these 2,000 plus companies who maintain their salary account with HDFC Bank. There has been a growth of 14% in the number of salary accounts. These 44 lakh employees today, as of March, had 54,100 crores of savings account balance sitting here. Now this is what, being a preferred bank to a corporate and leveraging. And then on these set of accounts, there would be cross-sell on the retail asset side that gets built in. I spoke in terms of the trade offering. If you look at it, we are present across both domestic and international trade finance, whether it is through a supply chain financing program, whether it is pre-shipment, post-shipment credit, whether it is buyer's credit. And the good part is that we work very closely with our treasury, and there would be opportunities and advisory that goes out to clients in terms of what is the best way to structure your borrowing. So if you look at it, US interest rates started going up faster, Indian rates were still lower, the forward rates were very high, and there were clients who actually decided to move their borrowing from foreign currency to rupees. And given the way we work closely with treasury, there were opportunities and solutions that we could offer to our corporate clients. If we look at in terms of letters of credit, today a large part of our letter of credit assistance to client goes towards cross-border trade, 82%. What it offers us is ability to then finance those transactions, plus cross-sell effects and help customers hedge their exposures. If we look at bank guarantees, the story is the other way around. Over 93% of guarantees are issued for domestic purposes. And this is where we believe the risk of guarantee transactions is lower. Now, if I look at in terms of the entire gamut of trade, whether it is import, whether export, whether funded or sent on collection, we have seen a huge 48% jump in terms of the trade transactions we handled. Now, does this happen through magic? No. There have been products, there have been solutions that we have offered to our corporate clients. If we look at in terms of the IDPMS and the EDPMS reconciliation that we provide, we pick up data from the DGFT side in terms of, say, a physical import that has taken place. We populate it on our TradeOnNet website, and a customer links his payment to an actual import. There is a reconciliation and a reporting that goes out. Now, these are the kind of value-added services which get extended to our clients, and that is where we see an increase in our trade engagement and improvement in wallet share. In fact, a lot of our transactions today are processed untouched by human hand. There is no need for a customer to send a physical paper when it comes to international trade to our trade desk. So what did it translate into? So when I compare volumes for FY21 with FY22, we have seen that there has been a total increase of 16% in the total transactions. And when we look at it, how many of these transactions were processed digitally? There was a 26% increase. So while we saw total transactions going up from 1,41,000 to 1,64,000, if we look at it, out of 1,64,000 transactions, 1,42,000 transactions, 87% of these transactions are digital. And this is what is creating stickiness, this is what is providing solutions, and this is something that is going to create a scalable model for us on the trade side. This is an area which is of a lot of focus for us. If we look at it over the last 6 months, and I mentioned that we came up with our new platform in Q3 of FY22, and we've already seen substantial engagement and increase in our volumes. Now, whether it is in terms of factoring both purchase and sales side, whether it is bill discounting, whether it is invoice discounting, whether it is supplier finance, you look at it, the model provides us ability to do a lot of things digitally. including credit underwriting, including documentation, including booking of transactions. There is a lot that would be very different. This allows us, and there is a slide later in the presentation wherein we'll cover the corporate supply chain landscape, and it offers us ability to do even deep tier financing. So there is a lot that can be done on this particular platform. This is a beginning. This is a platform where I can improve my yields without taking any incremental credit risk or measured credit risk. And it is something that a corporate may be cash rich, but this particular product is going to find benefit to all. The next thing, and this is where we have always been market leaders, we are today one of the largest movers of cash in the country. Over the last 1 year, we saw 24% increase in our volumes on cash management side for corporate bank clients. We saw 35% increase in value. And both volume and value comes across several sectors. Historically, over the last 5 years, we have seen that as you keep increasing your cash management collections and payment volumes, it translates into float. For a corporate, he would typically not leave idle current account balances. Your float is nothing but the time difference between your collections and payments. The more you handle transactions, both in volume and value, is where you are going to see incremental float. Second is, it also helps us in managing our portfolio a lot better. We get deep insight into what is happening across various sectors, what is happening in a particular company. So whether it is right from a check bounce rate to an average value of a transaction, tells us a lot of things about a corporate that you otherwise would miss out. We have also, over the last year and a half, increased our traction through digital integration through APIs. And 558 digital and API integrations done. If we look at it in terms of the total collection space on the corporate bank side, 92% of collections today are completely digital, untouched by human hand. 97% of payments are digital. And if we look at it, overall 94% of transactions, what I had mentioned earlier, are processed untouched by human hand. And given everything is digitized, our cost of running these kind of transactions runs into low single digits. So what do we do? I mentioned in terms of tax, and this is just the beginning, and we do believe there will be substantial growth in volumes here as well. For March 22, we ended up handling 2,25,800 crores of taxes. And I was just doing a little Google search, and I was told that the total direct and indirect taxes, including corporate and individual, in the country last year was 27 lakh crores. Now this is just the corporate bank customers contributing in terms of tax collection. Now with the e-freight coming in, customs duty coming in, more customers coming in, we do believe that the scope for further growth in our wallet share on this particular product exists. Now all of this, what we said, what does it translate into? Now why are we handling these kind of volumes? If you look at it vis-a-vis 21 versus 22, my CASA ratio in wholesale book has come up to 50%. If I look at it in terms of contribution of income, you look at in terms of fee, commission, FX, cross-sell, if you look at it, the contribution from some of these products has substantially gone up. So which means that the quality of the liability book has improved with the transaction banking that we handle, and we are able to leverage our asset volumes well for cross-sell. Coming to in terms of, if you look at it, we track our portfolio in terms of how well are we leveraging capital. So at this particular point in time, you would look at it that there is only 8% of the total portfolio which is high capital consuming at this particular point in time. Out of this, there is 1% where capital consumption is high but return is high. There is 7% where the return is lower for the capital that we consume. There are strategies around each of these clients, whether it is in terms of reducing the capital usage or increasing the cross-sell, so that each exposure starts contributing substantially to the revenue and shareholder wealth. Coming to in terms of what is our future thought process, and let me start by covering in terms of the entire digital space. So we have embarked on an architecture redesign wherein we will move away from the legacy system and move to a cloud-native, resilient, agile, scalable API platform. In terms of, we are redesigning both the corporate and the RM journeys as we move along. We are trying to leverage on the analytical tools that are available with us in terms of improving our processes as well as our ability to take a larger share of wallet. So let me start off with the employee experience. Here there is a single platform that is provided to a relationship manager that would cover end-to-end workflow. He'll be able to connect and collaborate a lot better with various other divisions of the bank with whom he needs to work, he or she needs to work. They'll be able to deliver a much better solution to the clients. We would be able to use analytics in terms of increasing not only our share of wallet, but identify opportunities for upsell and cross-sell. Now, this would also result into bringing in better insight. Say, for example, there is something in terms of the pricing engine that we are looking at. Here, just, it's commonsensical that there is, say there are two pharma companies rated similar, one in Hyderabad, one in Ahmedabad. If the Hyderabad company is borrowing at a particular rate, should the Ahmedabad company be borrowing at a different rate? If in a particular tenor, if there is something that is being done at a particular rating, someone with a lower rating should be getting a premium price over that. So there are a lot of insights that we are able to bring in to price our products sharper in the market. When it comes to customer experience, whether it is in terms of underwriting, whether it is in terms of the self-service mode that we would offer, whether it is our eNet platform, whether it is Trade on Net, in terms of how do we add value, how do we integrate with the ERP system of the client, and how do we serve customer better. On the transaction banking side, I spoke about the supply chain platform that we've come up with. We've also integrated with threads. We would also see a lot more self-service modules coming in to serve corporate customers better. On the ecosystem banking, there will be dynamic discounting, there will be deep tier finance, and deep tier finance is funding even tier 2. So I would cover it a little later in terms of exploring how a blockchain can be used. I think what is important is whatever we have put out on the digital side, what is it that our customers feel about us? So if you look at some of the testimonials, and I'll just highlight a few points, that they say technology is flexible, ease of implementation, integration with the ERP system, and ability to digitize everything. And these are the things and feedback that comes in from the customers. And it's a continuous process wherein we look at seeing how we can improve ourselves. Coming to the supply chain landscape, what I mentioned about, and this is going to be a big area of growth for us. If we look at it, there is a corporate at the center, you have suppliers, and then you have supplier to supplier. So you're going into the tier 1 vendor and the tier 2 vendor on the other side. On the other side, you have, depending on the business model, you can have the 2P, 3P manufacturers, Now post GST, you are having a lot of warehouses. On the other side, you have the dealer distributor network, you have retailers. Now whether through the supply chain finance platform or through partnerships with various other verticals within the bank, we do believe that we have solutions to cater to the entire ecosystem. Now there would be primarily banks who are our competitors here, and we are looking at competing better through some of the partnerships, whether it is with fintechs, whether it is with other verticals of the bank. And if you look at it in terms of the risk profile, a lot of it is predicated on the corporate cash flow on the vendor side. It is partially mitigated through long-term contracts. And where you have the customer risk with the use of technology, picking up with the consent, the GST invoice details, a lot more can be done without running incremental risk. And therefore, the opportunity space on this side is very large. In terms of a vision that we share at this point in time is to become one of the largest and the most preferred bank to multinational companies in India. At this particular point in time, last year we had 693 clients here. We initiated relationship with 59 more clients through last year. If you look at this particular space, most MNCs in India have an asset-light model. So here your asset opportunity will be limited, but opportunity when it comes to liabilities in terms of cross-sell, in terms of FX is huge. At this particular point in time, we have an identified list of 2,000 multinational companies that work in India. Now these are divided by country of origin, these are divided by business lines, these are divided by head office geographies. We've started engaging with these set of clients directly through Chamber of Commerce, through their consulates, and we do believe the potential of initiating engagement and playing a pivotal role in their businesses in India exists. And this can be a very, very big driver for us. So while we spoke about multinational clients, what about new to bank clients for corporate bank? So if we just do a simple search, and you can, a lot of this data may not be available through one single public source, but there would be, as per our database, there are 2,237 companies in India with turnover in excess of 1,000 crores, which is the threshold for corporate bank to deal. Out of this, 1,066 plus companies are currently dealing with us on the asset side. If we look at it and we applied certain filters, we said companies rated with a minimum rating of A minus. We looked at it in terms of a bureau scrub. They should not be having any SMA reporting. And when we look at this particular addressable base for us, there are still 617 corporates who do not deal with us at this point in time. When I look at what is the total debt across these 617 companies, that is 11 lakh crores of debt, out of which 80% is long term, 20% is short term. Now I may not want to deal with all the 617. All 617 may not deal with us, but this is an opportunity space that exists where we would be able to bring in new to bank clients. And when you look at what is not with you and compare it with the size of your book at this particular point in time, this offers great growth opportunity. In terms of PLI scheme, I'm sure I'm not going to give you a lecture on PLI scheme. I'll limit myself only to cover in terms of the opportunity that exists. So there are 14 sectors, 16 schemes, a total outlay by the government of 2,03,000 crores on the PLI side. Out of the 14 sectors, 12 sectors, they've given the approved list of applicants. Across these sectors, there are 600 companies who have already received approval. In terms of the capex that these guys have committed is to the tune of 2,34,000 crores. Now for us, we have in our segment of 1,000 crores plus, we have identified set of companies who are participating in PLI. Some of them happen to be our existing clients. Some of them are our target relationships. Some of them have crystallized their capex plans in terms of the division between debt and equity. Some of them are still working things out. This gives us an opportunity not only to participate on the debt side, but work along with the investment banking team on equity side mandates as well. So this is going to be the other opportunity for us to fuel growth. So in terms of, just to summarize, what is it that corporate bank is bringing to the table, and where do we see the future coming in? The first thing is in terms of increasing our share of wallet in our existing to bank clients, and two is in terms of bringing in new products to your existing customer base. To this, for this particular initiative, we've embarked on a journey which we internally call perform to potential. What is this? So if you look at two companies in the same industry, say you pick up industry of your choice, say automobiles. Would two companies in automobile space have a very different business model or similar? If you have a better engagement with one of the automobile companies, means you have understood the pain point of that particular industry, that particular company better. Can you then replicate it? And same is true as you move from one industry to the other. So how are you taking your learnings from a particular company and replicating it to other companies across the country? And we do believe that through this particular initiative, we would be able to substantially increase not only our wallet share, but bring in new products to our existing clients. Second, I covered in terms of the new to bank opportunity, so not dwelling further, but that is going to be a growth driver. Third is in terms of participating in opportunities that the economy will provide us, whether it is the production linked incentive, whether it is going to be the asset monetization plan of the government. As I mentioned, supply chain integration is going to be a big driver. One, it is going to help us create value to bring in higher yields. And three, in terms of companies can become cash rich. Companies can look at alternate avenues. But supply chain is a product that is here to stay. We're looking at serving the customers through new products. There are quite a few exciting products that we would come up with on the international trade side, which would add value to our customers and help us gain market share on that side. I've already covered in terms of the MNC piece, how what is the opportunity size and what kind of contribution in terms of liability, FX, cross-sell that they can bring in. All of this is being done through digitally integrating better with our clients. And there would be services. So from a regular cash management, can we move into a cash management with invoice level reconciliation for our clients? And that's something that the fintech partnerships will provide. So we do believe that growth in corporate bank, opportunities are far too many. It is in terms of selecting the right set of clients, not moving away from the core principles that we've over the years built corporate bank on, and in terms of improving the quality of earnings through better engagement with the clients. And that's something that we're looking at delivering from the corporate bank. Thank you. Yeah, so if there are any questions for Jimmy or me.
So we will take only 2 questions. Anyone have any questions? Part 1.
maybe not directly related, but if you can give us the idea what is the outstanding share of infra bonds on our balance sheet right now, and how do you see the appetite for that particular product in the market? Thank you.
Numbers, I think, please talk to Srini or Bhavin and Ajit, they'll give you all the numbers. But we manage infrastructure in very different way, right from maybe the smallest construction equipment up to the largest product. Infra bonds, more of a financing issue. I'd ask you to speak to Srini on that one.
And opportunity that you guys mentioned about 11 lakh crores, that 600 plus corporates that you, so what would be, because traditionally HDFC per se stayed away from the long-term financing per se and more towards the working capital loans, if I'm not wrong. So would this large chunk of this would be towards the infrastructure kind of a segment, considering 80% is the long-term financing into that particular product?
No. Go ahead.
Yeah, so let me put it this way, at this particular point in time, and if I even just to be a little conservative, even if I take 5-year plus as long term, today 40% of our book is with door-to-door tenor over 5 years. So there would be certain installments that would be paid even on the way, but if I just pure cut it by door-to-door tenor, it is 40%. Second is, if there is a lot of strategy that has gone behind, and if I cut this particular data by corporate rating, a large part of my 5-year plus is in companies which are rated very highly. And as you keep moving down the rating chain, that particular amount just starts becoming smaller and smaller. Third thing is, in terms of infrastructure, there are various ways in which we participate. So there can be a debt finance where the project risk is complete. There are infrastructure projects where cash flows are determined, you are not really running the risk. When asset monetization happens, more you will see that because of those InvIT structures, there are restrictions in terms of the kind of debt that is taken there. There are certain long tenor loans that we would have given, which may not be really project risk, but maybe a balance sheet risk, because there are enough and more cash flows to support even if a particular project was not to go through. So we will always remain cautious in terms of what we do, but in this particular country, can you really avoid funding projects? Answer is no. But can you do it diligently? Answer is yes, and that is what we will endeavor to do. Jimmy, anything else you want to add?
If I can give a minute's flavor on, just to allay, I think the fear is misplaced. Long term, firstly, does not mean infrastructure, and I think Nirav alluded to that. A large part of our long term is actually out to corporates, manufacturing companies, and the government and public sector companies. I think a very, very significant part of our long-term exposure is out in what I call Navratna quality. They may not all be Navratnas, but Navratra quality public sector undertakings. So it is safe over there. The mix, and I think as the bank grows, there is a need to participate more and more out of just a niche of working capital and to be across the entire spectrum of lending. More than that, I think the bank also, as it becomes something of considerable size, is important to have duration in your book. And if you do it safely and you do it right, and we have till this point succeeded in doing that quite well, we have managed to create duration in the book, and we have not assumed a higher level of risk. I think the risk scores you just heard from Nirav, the PSU and the corporate scores overall, they're very, very low. You heard it being a shade under 4 for the entire book and shade under 3 for the PSUs. To give you some color, you've got to be a shade under 5 to exhaust AA. So that's the quality of the book, including the long-term exposures that are held at this point.
Okay, and just the last question on the corporate bond markets. Over the last 3-4 years, we have seen India has developed significantly on the corporate bond markets, right? And prior to COVID, we were building in a lot of capabilities to build on this opportunity. So can you just give us some flavor what has happened over the last 3 years wherein our corporate book was growing, how we have capitalized this entire journey of corporate bond markets, and how do we see ourselves 5 years down the line? Thank you.
So let me take it in two parts. One is in terms of participating. We work very closely with our treasury and the investment banking team in terms of helping corporates place their debentures. So that's one area where we do a lot of work jointly with IB and treasury. Second is in terms of, so you saw a spurt in both issuance of commercial papers and debentures. But if you see the market over the last 2 months, the issuances have completely dried out. And at this particular point in time, if for us, it's a customer asset. And we would look at a customer asset from the point of view that part of my overall strategy, where does this fit in? Do I really need to participate on the investment side? No, my participation is not very large at this particular point in time. But if there is an opportunity that can be leveraged well, we would look at it. So it's time to time, client to client, the strategy would vary. But at this particular point in time, even the primary market for issuance has dried up and we are not doing much on the corporate bonds. Interest rates are going up, so it does not even make
If I
much
can
sense to
just, if you look at how the corporate bank behaved throughout the last 3-4 years, if you look at the TLTRO period, you'd have seen us very, very active over there because that was the time companies were shoring up liquidity and raising a lot. Participating in bonds actually brings additional risks, and if you have a good enough business franchise, what does a bond do effectively? It kind of commoditizes the finance, so it brings a very standard, you're not able to really fine tune what you want. And of course, it brings market risks into the equation. If you're not going to be able to price those risks in, you're probably better off with an advance. So it's something that we look at from a case-to-case opportunistic perspective. We're not really looking to participate in a bond market for the sake of participating. When we find the good transactions, we definitely pick them up, and we pick them up with good, large appetite. But it's not necessarily a must-have for us that we must have bonds. We don't really have to have bonds. We would like to be a good part of the corporate's business, both on the working capital as well as the long-term side. And we would much rather structure products that are for that company, for that moment, for that time, for that event.
So when we do a back of the envelope calculation, your corporate yields basically work out to somewhere about 6.5%. So is that the right working basically? Because basically you are doing more of AAA corporate, you are gaining market share as well. So that's the strategy that you adopted.
So I don't know.
I don't have your envelope, but
I don't know the back of the envelope working, and I would leave it to Pinpon to provide you details if that is out in public domain. But I would let me try and explain to you in terms of you cannot look at yield as an absolute number. The way I would look at yield is how much of my book is floating versus fixed. So again, in terms of floating, whether it is linked to MCLR, whether it is linked to repo, whether it is linked to T-bill, what is going to be my ability to transfer rate hike to somebody else? So I can give out a fixed rate loan to someone wherein I can get a much higher yield, but the book ends up taking interest rate risk. The second way of looking at it is, as you keep going longer on tenor, your yield keeps on going up. So I can have entire book long term and give you a much higher yield. But in that case, you are compromising in terms of the credit risk. I can go down in terms of quality of corporates, and as you keep going down the rating chain, you keep getting an increase in yield. But would I want to balance the book well? So it's a combination of fixed versus floating, it's a combination of rating, it's a combination of tenor, and you need to look at it in that particular way. And we do believe that we would not want to do anything stupid just to increase yield and compromise on something that has been so beautifully built. And it's a pristine corporate bank book that has been created over the years. What you require in corporate bank relationship is continuity. And today when I look at when I look at the life of the bank, 27 years, and corporate bank was the first division that the bank started. Kazad mentioned about it. One thing is consistency. We have stayed on course in the market for all 27 years. There has never been a year that we exited. Now it takes years of relationship and engagement to actually build relationship. It takes a couple of years of effort to break into a large company. It takes another 2 years to cross-sell products. And if you are inconsistent in your strategy in terms of at one point in time just go aggressive, pull back, go back, customers and the corporate customers don't like it. So what we've built is step by step in a manner that we never have to jerk our relationship. And that's the level of confidence we would bring in when it comes to the book composition, and yield is a impact or a factor that comes in from the book that you created.
So certainly it will be on the lower side because that's a drag that you see on the margins front as well, right?
So that is
Can
where
I just, I think if I don't know how many times we put it out before, but today we did put out the RAROC. You can bring yield, but at what risk do you bring in the yield? And that's exactly what came out. I don't know how many corporate banks have that RAROC.
So we would have one of the best
I really
risk-adjusted return on capital in the banking industry. Part one. Part two is the cross-sell that we bring in. Now, some of it may, and some of the income that we generate may not sit within corporate bank, may sit outside. But effectively, it is not about each division being a bank by itself. It is one bank. And what is it that you are contributing and taking the power of one bank to the client?
Secondly, on the fee side, so we have done a lot of lending over
So
past
this will be the
3 to
last
4 years.
question.